Hello and welcome to another video on our healthy trading habits. Today we're going to talk about Volatility Matters. But before we start, please read the risk warning. Our investment products and services are not suitable for everyone. It is possible to lose all or part of your investment. For leveraged products trading, it is possible to lose more than your initial deposit. Trading on margin carries a higher level of risk, and it is possible to be required to deposit additional funds. You should not invest money you cannot afford to lose. And with that said and done, this is me. I'm your host today. I'm head of trader development here at FCI Markets. And what you need to know about us at FCI Markets is that we are here to give you the tools to become a consistent trader. We want to help you simplify your trading habits and join our trading desk earning a fully funded account. And then you can either trade from our premises in the UK or remotely from your own home. On that note, let's get into today's session. Volatility Matters. I want to start with a quote by Warren Buffett that I think sets the tone. Buffett said, "The market is a no-called strike game. You don't have to swing at everything. You can wait for your pitch. The problem is that your fans keep yelling, 'Swing, you bum!'" Well, this is exactly one of the main concerns and why today we're talking about volatility. The fact is that most traders look for action. They can't sit still. They look for action. They're looking for trades instead of waiting for their pitch. Most traders also feel that they aren't doing a proper job unless they are actually trading. So you all know the saying, not having a trade on or being flat is a position. And often it is the most frequent position to have. And instead, most people usually just want to feel active, just like a 9-to-5 job, and they want to be constantly in the market. And third, most traders are often trading too close to the markets to realize that in fact they are over trading. They're following tick by tick, or they're following minute by minute, or they're following all these very short-term time frames, and they don't realize that perhaps they're trading in the middle of nowhere, or they're trading when nothing is happening. They're unable to discern when they should be waiting for their pitches and when instead they should be taking a swing. So volatility is one way to discern market states and help you wait for your pitch. This is the Deutsche Bank FX Volatility Index, sourced from New York Stern. It is a well-known fact that when volatility rises, it is easier to profit in the markets, and traders can become also more aggressive by pyramiding into positions, by being a bit more active in the markets, because when there's more volatility, there's more movement, and traders need movement. They need that volatility in order to actually do something. When the markets are extremely still, there really is nothing to be done. And as a testament to this, I know the chart doesn't really show it very well, but at the beginning of 2019, there was a steep drop in volatility. From a slight uptrend in volatility actually just collapsed. And I was trading in that time, and I remember it very clearly. That was one of the toughest times for me to trade personally. I got into a drawdown that period, and I had to adapt my trading in order to survive because volatility simply disappeared and things started chopping around. So traders need to be aware of this. They need to adapt as quick as possible. They need to realize in real time when volatility is either expanding or contracting, and then take a more aggressive or more conservative approach. That's basically what volatility will help you do. It will help you understand whether you should be more aggressive or more conservative. And it is an unequivocal way to do this. Now, looking at a volatility chart ex post like we just did is nice for educational purposes, but it doesn't really help you trade in the here and now. Directional volatility is easily measured actually with the ATR, with average true range. And directional volatility simply means that things are moving. It's a bit different than the concept of standard deviation. Standard deviation means things are moving up and down, but not in a directional manner. And what we're interested in instead is directional volatility. So when things are continuing, when things are pushing in the same direction. And that's when you can be less conservative. That's when you can be less selective. Instead, when things are quiet or when things are just chopping around with volatility, but with no directional volatility, with no trend, then you need to pick your spots wisely. So applying an ATR to a weekly chart to discern market environments in a similar fashion to the Deutsche Bank FX index, this is what you see. This is a 13 period, so obviously we're on a weekly chart, so it's a 13-week ATR. And you can see, exactly what we're talking about, how volatility does have cycles. It declines and then it starts to rise, then it declines again, it starts to rise. But when you're trading each day of each week, how do you actually use this in a proper manner? Here is one way to do so. And before I get into the details, please know that these are not special indicators. There are many programmers who have created free ATR and ADR indicators for MT4 and MT5. You can probably check them out yourself. As long as you understand the concept that we're talking about today, that's all that matters. So here is what I like to do to measure volatility in real time. What you see applied to this chart is simply what I call ATR pivots. So based on today's opening price, I am plotting a certain percentage of the 13-day ATR to the top and to the bottom of the opening price. So as an example, this is today, this is the 70% mark, so this is the open plus 70%, this is the open minus 70%, this is the open plus 100%, and this is the open minus 100% of the 13-day ATR. So what this shows me at a glance is whether we are contained within these percentages or whether we are expanding beyond them. So we can see some examples here. You can see how, for example, this day up over here was a clear expansion. So I know it's a volatility expansion. I know going into the next day that we had an uptick in volatility. Now vice versa, the day previous was a very short range day. It just made it to the 70% mark and remained contained within there. And this day here was even smaller in a similar fashion. These were two fairly normal range days. It can help you pinpoint in real time whether the market is quieting down or calming down or remaining constant or expanding. And as traders, we really need to do this on a day-to-day basis, understanding and visualizing volatility in real time. Now, the other thing that these volatility measurements are useful for is a safety net before entering trades. For example, if I'm going to take the euro long, okay, am I going to try and take the euro long, for example, when it has already passed 70% of its daily ATR? So I know that, from a probability standpoint, it may have 30% left if it's going to print 100% of its daily ATR, but the market doesn't always print 100% of its daily ATR. The market will contract or it'll expand. We don't know what it's going to do. So we have to use volatility as a filter. And that's why I like to enter trades when I have enough ATR left on the day to justify my entry. Usually that means that I'm entering pro-trend early in the day, or if I am going to try and go counter-trend when we have exhausted ATR or when we're near an ATR limit, then I might be looking to do that later in the day if the conditions dictate, if I actually have a setup. Remember, no setup, no trade. We're only talking about principles here. But ATR is extremely useful because if you are entering a trade when ATR is exhausted, for example, let's say you want to take the euro long and you're trying to trade near the New York close, we have already gone so far during the day. The odds of continuation are very low, and the odds of reversal are higher the further up you go, the more ATR is consumed. So basically it just requires more patience. You wait till the next day, and then ATR is recharged and you have space to move. This of course is valid also on a weekly basis. So you can see here we have some of the leftover daily ATR lines, and here we have the weekly ATR lines. So the week's open, minus and plus 70%, minus and plus 100%, minus and plus 70%, minus and plus 100%. And you can notice how, for some reason, the market does respect these levels. It goes and tests the 70%, comes back down. Tests the 70%, comes back down, and then it breaks through. This week, we actually are having an inside week for the time being, and you can see very clearly we're trading around the open. We haven't actually gone very far. We haven't even pushed the 70% mark. So we are trading very quietly this week so far. Vice versa, you can see how some weeks they push to the 70%, they barely retrace at all, and then they just continue. And you sense, you can feel in real time the expansion in volatility. So it helps you, and not just on a daily basis, but also on a weekly basis, as we're seeing. If you are rolling over your trades, or if you are taking a trade later in the week, you can ask yourself the same question, like how much has price traveled this week already? If I'm trading on a Friday, and price has already pushed beyond 100% of its ATR, what are the odds of having a nice trade? What are the odds of having a nice extension into the weekend? They're not very high. So it helps you to manage the odds of your trades ahead of time, because you know how much space there is, how much space you've covered, and what could potentially be left. I hope this video was helpful, and it gave you a bit more insight into the importance of capturing volatility and measuring volatility in a consistent manner. But if you need more guidance, there are a few things that you can do. Number one, come to our blog and subscribe. We publish morning calls, weekly calls, and thought leadership pieces on our blog each week that are useful in order to help you become a more successful trader. The other thing is that you can follow us on Twitter at FCI Ltd UK. We post only the most influential market-moving news on here and the occasional trade call. The last thing, if you are serious about becoming a professional trader and testing yourself on a funded account at FCI Markets, then come and do our Professional Trader Academy. This is where I teach time-tested methods to interact with the market, and I help you become a consistent trader. As usual, we're happy to hear from you. We're happy to help you. Just get in touch. Either give us a call on our phone number, or reach out to us on our email, or even pay us a visit at our headquarters in the UK. At FCI Markets, our main concern is to help you become a consistent trader. And so ask us really any question that you have. The only dumb question is the one you keep to yourself. This is Justin Paolini for FCI Markets. Over and out.